Good morning. Welcome to the Consumer Financial Protection Bureau's public meeting of its Academic Research Council, or ARC. My name is Ron Borzakowski. I'm the Deputy Assistant Director of the Office of Research at the Consumer Financial Protection Bureau. Today's public meeting is being held at the Bureau of Engraving and Printing in Washington, D.C. This is the ARC's annual public meeting, and we have a packed schedule. Today's public meeting is being recorded and will be available at consumerfinance.gov. Let me spend a few minutes telling you about what you can expect at today's ARC meeting. First, I'll introduce the Bureau's ARC members. Then, the CFPB's Director, Richard Cordray, will provide opening remarks. Following the Director's remarks, ARC Chair Chris Carroll will resume his responsibility for conducting the meeting. ARC members will provide comments on recent trends in consumer finance research. Chris Carroll, the Bureau's Assistant Director for Research and Chair of the ARC, will provide an overview of the activities of consumer financial protection agencies in other countries. Ken Brevoort will describe the Bureau's recent work on access to credit reporting. And Alexei Alexandrov and Kelvin Chen will provide an update on the Bureau's recent arbitration study. The public meeting will adjourn at about 11:30. The Bureau established an advisory council with leading academics from throughout the U.S., and the council has served the Bureau well. Our Academic Research Council advises the CFPB by sharing their unique expertise on research strategy and methodology. Today's public meeting and discussion is in support of this important responsibility. So as a reminder, the views of the ARC members are their views and are generally appreciated and welcome. However, they do not represent necessarily the views of the CFPB. So let's get started with an introduction of our ARC members. Raphael Bostic. Raphael is the Judith and John Bedrosian Chair in Governance and Public Enterprise at the Saul Price School of Public Policy at the University of Southern California. John Campbell. John is the Morton L. and Carol S. Olshan Professor of Economics and Chair of the Department of Economics at Harvard University. Justine Hastings. Justine is an Associate Professor at the Department of Economics at Brown University. Christine Joels. Christine is Yale Law School's Gordon Bradford Tweedy Professor of Law and Organization. And David Leibson. David is the Robert I. Goldman Professor of Economics at Harvard University. Unfortunately, 3 members of the ARC could not be here this morning: Richard Thaler, Antoinette Shore, and Mel Steffens. We also have with us Delicia Hand, CFPB's Staff Director for the Bureau's Advisory Board and Councils. So I'm now pleased to introduce Richard Cordray. Prior to his current role as the CFPB's first director, Director Cordray led the CFPB's Enforcement Office. Before that, he served on the front lines of consumer protection as Ohio's Attorney General. In this role, he recovered more than $2 billion for Ohio's retirees, investors, and business owners, and took major steps to help it protect its consumers from fraudulent foreclosures and financial predators. Before serving as Attorney General, he also served as Ohio State Representative, Ohio Treasurer, and Franklin County Treasurer. Director Cordray.
Thank you, Ron, and thank you all for joining this public session of the annual meeting of our Academic Research Council. And of course, we're looking forward with great anticipation to the research conference beginning later today and extending into tomorrow. Let me start by noting how much we appreciate, how important we feel is the opportunity we have to discuss consumer finance issues with these notable experts in the field. They generously have agreed to take time to share their perspective and expertise to help us consider how we can best protect and empower consumers in the financial marketplace, which is central to the Consumer Bureau's work. We're grateful for their interest and their thoughtfulness. As all of you here probably know, Congress created the Consumer Bureau's Office of Research as an integral part of the financial reform law. Specifically, the Dodd-Frank Act charges this office with, and these are all quotes from the statute, researching, analyzing, and reporting on developments in markets for consumer financial products or services, access to fair and affordable credit for traditionally underserved communities, consumer awareness, understanding, and use of disclosures, consumer awareness and understanding of costs, risks, and benefits of consumer financial products or services, consumer behavior with respect to consumer financial products or services, including performance on mortgage loans, and experiences of traditionally underserved consumers, including unbanked and underbanked consumers. That's quite an agenda, isn't it? It's really an important and immense charge, and our team works at it with commendable vigor and creativity and focus, and many of you will be interacting with them today. I plan to talk more about our authority and our responsibilities at the opening of the research conference later today. For this morning, let me point out that early in our history, we established the Academic Research Council to support the Office of Research in this mission. The Council is composed of scholars with diverse and relevant methodological expertise and subject matter experience drawn from a wide range of institutions. The Council advises us on research methodologies, data collection, and analytical strategies. It also provides us with valuable feedback about our research, which has helped us greatly so far. We're quite aware of how fortunate we are that these leaders in their fields have been willing to advise the Consumer Bureau about our direction and our objectives. So let me thank the Council members for their participation and their service. Your involvement with us helps ensure that our research is held to the highest standards and that we're able to maintain close and important ties with leaders in academia. We look forward to what we know will be a fruitful and most interesting set of discussions this morning. Thank you.
So our first session this morning is an opportunity for the ARC members to share their insights, as Rich was just saying is their role, about the developments in academia that they think ought to be foremost in our mind. So we're just going to turn to each of the ARC members and give them a few minutes to let us know what they think we ought to know that is coming from the academic world. We'll start with David Leibson.
Good morning. The specter of deflation has been haunting Europe for the past year or more, and as I'm sure you're all aware, that specter has skipped across the Atlantic over the last couple days and is now haunting Boston. And I'm sure, as many of you recognize, there are a lot of Boston economists up here on the podium, and as you may be wondering, can you trust an economist from Boston? This morning, I fear probably not. But let me turn to another topic, more relevant for our meeting today. I want to talk about leakage. And as many of you know, when the 401k IRA retirement savings system was set up, essentially 20, 30 years ago, we all had in mind that people would put money into these accounts, and essentially it would sit there until they were ready to retire. But it turns out that that expectation has failed, and we have a new norm, which is that a lot of the funds that go into these accounts come out decades before retirement. The most recent paper documenting these trends is actually written by someone with us today, John Sablehouse, and his collaborator. John, where are you in the room? I don't see you anywhere. Well, okay, there he is. John Sablehouse and his collaborators, Robert Argento and Victoria Bryant, have been documenting the leakage out of these accounts. And essentially, there's about $100 billion a year coming out of 401k and IRA and other of these defined contribution retirement accounts to households under age 55. And I'm not talking about rollovers, I'm talking about distributions, taxable distributions. Now, if you look at the ratio of these withdrawals to the under 55 crowd divided by the contributions into those accounts made by the under 55 crowd, the withdrawals represent 40% of the contributions, which is an enormous reduction in the ultimate accumulation in these accounts. Now that begs a very interesting and important question for us, which is this a good thing? Is this a problem? On the one hand, you think, well, households have financial emergencies. Households need liquidity for lots of legitimate reasons. There are all sorts of events that trip us up, and at those moments of unemployment or health shocks or some other financial calamity, we very much need liquidity long before we're in retirement. On the other hand, in behavioral economics, we see that there are lots of reasons that people spend too much. They make mistakes, they have self-control problems, they spend prematurely and get themselves into financial trouble by accumulating too little for the end of life, for retirement. What I've been trying to do is think through these issues by building some structural models. I've been working on this with my collaborators, John Beshears, James Choi, Chris Clayton, Chris Harris, and Bridget Madrian. And when we write down models of behavior for US households, and we ask what would the optimal retirement savings system look like, and what would be the optimal amount or the socially efficient amount of leakage from these accounts, in a world where people both face occasional financial emergencies and also have self-control problems, we find that the optimal system, at least in these theoretical models, is a system that looks a lot like what we see in the US right now. A system dominated by a first pillar with an aggressive Social Security system, and then a second pillar of 401k style accounts that have penalties of approximately 10% for early withdrawals, that have some special categories where early withdrawals are not penalized, and that at the end of the day end up with leakage rates of about 50% of the money that goes into those accounts. So I think we've got an interesting question before us, a very important question, as we think about the ways that consumers obtain liquidity to address emergencies. For example, credit cards, payday loans, and now 401k accounts and IRAs. Is the system of obtaining liquidity socially efficient? Have we built a good retirement savings system, or do we have a lot of reforms to make to fine-tune it and make it better? This is an important research agenda looking ahead. Thank you.
Thank you very much, David. Our next speaker will be Justine Hastings from Brown.
Great, thank you, Chris. So I really enjoyed listening to David's comments, and I think he commented on a very particular problem. I'm going to talk a little bit about approaches, because that's kind of what I'm interested in at the moment, thinking about approaches to solving problems, particularly in government. I really enjoy a lot of my research works very closely with government agencies. I've done a lot of work with both agencies in the US and also foreign countries, the government of Mexico, most recently the government of Chile. And really using data and economic models and actual testing of policy to figure out what works. How do we design policies that have the most impact per dollar, that serve the people we're trying to provide services to as best as possible, given their constraints, and also given the marketplace. So kind of one of my areas of research expertise is in industrial organization, marketing, and strategy. And I really like to think about turning the questions that are important for industry on their head and making them important for government. How does government best design products? And how does it think about the impacts of its policies, both for people and people who are operating in a market where firms may also respond, or there may be distortions that are caused by those policies. And I really like, there's a very big push right now from Washington and also up from state and local governments to put data to work for government. So if we compared, for example, some of the industry partners that I've worked with, the amount of knowing your customer that industry does relative to the amount of knowing your customer that government does, I think there's a pretty big gap. And a lot of my research really works on filling that gap. Who is our customer? How do they use our product? What makes it easy for them to use our product? And the second point I would say is industry really spends a lot of time on knowing your competitor. So not just who am I serving, but kind of what is my competitor doing and how do I best respond to that? And in some contexts, you can think of the government's competitor as potentially industry. Or you could think of industry as a collaborator, depending on where the different objectives of each party lines up, but thinking carefully in policy design about not only knowing my customer, but knowing the marketplace, knowing my competitors or my collaborators and how they're going to respond to what I do is really important. And a lot of my research and collaboration has focused on answering some really difficult questions. Sometimes in industry, if we were to think about what are the problems you need to solve, you might solve something like, you know, how do I price store brand salad dressing versus national brand salad dressing? And these are kind of decisions that people are making over and over, and places where product characteristics somewhat are very easy to figure out, prices are easy to figure out. And a lot of the things that we're really concerned about, the social safety nets that the government provides, some of the big programs that we're interested in really helping people in need, they involve complicated decisions. And for example, they might involve savings for retirement. How do I think about drawing down my 401k or contributing to it? How do I understand my Social Security retirement benefits? Education investment. These are things that I make one decision once. Where do I go to college? What degree do I enroll in? Do I graduate high school? They're not repeated actions where people can kind of learn a lot about the decision-making process, but instead they're actions where you get kind of one shot at a big decision that sets the course of your life in a lot of ways. And so there is a big role, an even bigger role for product design, so to speak, and for government to think carefully about product design and to measure what's effective and what's not in those types of arenas where it's not easy for the person themselves to measure what works and what doesn't because they don't get to make the decision several times in a row. I think the second component of research that I'm very interested in is defining what works. So I kind of said I'm interested in thinking about government using data and using policy tests and using economics and science to figure out what works, but that means that there's an objective. How do we define a successful higher education market? How do we define a successful welfare program? What's the objective function? What do we see as a success versus not? And then how do we design policies using models, economic theory, behavioral theory, psychological theory, and then test those policies and get a real measure of where are we being effective and where can we be more effective. I really see this as both a cornerstone of my current research, and I think it's a really, it's the path of future research and policy as we move government to be smarter and more efficient in serving the people that vote for it and create it, and particularly people in need.
Thank you very much. Our next speaker will be Raphael Bostic.
Good morning, everyone. It's good to see you, and it's good to not go last, because we were asked not to overlap, and they've already covered some very important areas. I wanted to start by just saying that it's a privilege to be here. This is an important topic, and it's an important issue, and this is an important area, and I'm really pleased to be part of the first public hearing that the ARC is having. When the CFPB was created, for me, the most important aspect of it was that we were going to talk about these consumer-based issues in public on a regular basis. So doing this in public is quite important. When I think about consumer financial protection, I think about it in a framework of 3 lines of defense. That what we're trying to do is have a system where we have redundant defenses to prevent bad outcomes from happening and get people to better places in their lives. The third line of defense is enforcement. That's when everything else, all else has failed and we go to court. The second line of defense is regulation, setting the rules of the game so everyone knows what you're supposed to do and not supposed to do. What does the consumer know, and how do they prevent themselves from getting into a bad situation? And for me, I'd like to highlight and raise up the question of how do we improve the first line of defense? What are the mechanisms that can strengthen consumers so that we don't need to get to enforcement? And for me, I get to this question out of my experience at HUD. When I came here in 2009, we had something called a housing crisis. And that housing crisis was caused in large, well, to some extent, because people, they didn't understand the risks they were taking. They may not have understood the products that they were engaged in. We had actually failed in the first line of defense. And that's always stuck in my head in thinking about, as we move forward to prevent those sorts of things from happening before, what can we do to improve the first line of defense? Then the second piece of that experience was that after the crisis was going, there were resources that were available to consumers, such as the refinance programs, the loan modification programs, and many consumers didn't do them that should have, right? And that suggested that consumers perhaps lacked some intuition about what things are in their interest and which things are not. And so when I think about research that needs to be done, I want to think about how do we improve the first line of defense as consumers are going through transactions, and then how do we improve the first line of defense in the sense of consumers having intuition about the things that can work in their favor. So in the first dimension, I think about financial literacy as an important dimension, and where I feel like there's a lot more research that needs to be done around how do you improve financial literacy, how do you get people to what we would think is a minimum threshold of acceptability, and then to really understand what the costs of financial literacy, of poor financial literacy are, so that we can start to make the case that we should invest in improving it for everyone. And so I'm indulged in engaging in some research now where we are looking at the impact of poor financial literacy in the state of California in mortgage markets. What has it meant in mortgage markets? And our preliminary estimates suggest that there are costs on the order of hundreds of $millions on an annual basis for people, just because people have poor financial literacy. It's a substantial issue, and that's just one state. It's a big state, but just one, which would suggest that this is a national issue, a concern that, that we need to be talking much more about and understanding much more deeply. I would also say that the question about intuition and how do people come to intuition and how do you shape it is really a question about decision-making, heuristics, basic preference functions that people have, and more research on understanding the nature of those functions and how they might evolve over time and what kind of cues can lead people to get to better intuition is a second important thing that we should pursue. And for me, it's exciting. I start off as a psychology major, so this notion of people's preferences and how institutions and structures can cause people's preferences to seemingly change and change in ways that are not always in their long-term interests has been a long-time interest of mine. And so I'm looking forward to future conversations with all of you and engaging in these issues and seeing the research that's to come. Thank you.
Thank you very much. Our next speaker will be Christine Jones.
Let me start by just echoing what Raphael said, that it's really been a privilege to try to be involved in this exciting time at the Bureau. I'd like to speak briefly about a research development that I'm excited to see becoming quite widespread in empirically studying financial institution practices and potential government policies in response to those. And that strategy is to use randomization in real-world environments to study effects on how people conduct their financial affairs. To give a quick couple of examples, we really need to look no further for the first example than today's research conference. Suppose we want to study how changes in the interest rate paid on overdraft protection affect the likelihood that a consumer will overdraft. A generation ago, the primary way to examine this question, if one were seeking to study it, would be to convene a focus group or some other group of individuals and sit down in a room and ask some carefully constructed questions and glean what we could from responses to those questions. I think now the first line of attack would be something like what we'll hear about later in the conference. We can try to study a very large data set of consumers in their actual day-to-day life to see what the effect of changing the interest rate on overdraft protection would be. In the study in question, consumers are randomly sorted into two different groups and receive text messages providing two different interest rates for overdraft protection from their financial institution. Then we simply sit back and watch what consumers do in the ensuing months. And we study in each group what the frequency and pattern of overdraft behavior is. Since the two groups have been randomly sorted, if we do see a difference in overdraft likelihood, we can have some reasonable level of confidence that it may in fact be associated with the difference in interest rates that consumers were alerted to and received from their financial institution. So that's an example involving financial institution behavior. Let me give a second example that involves the government using a similar strategy. And this example is, I think, the best known to date instance of using randomization to test a policy change within government. The SEC, after struggling for quite some time with its rules on short sale restrictions for stock, and having seen dueling studies from economists on the effects of these restrictions on volatility and other stock market behavior of the affected companies, decided to randomly exempt 1/3 of companies from the SEC short sale restrictions. And then, just as in the overdraft study, the behavior of the stock of these 1/3 companies compared to the remaining 2/3 of the companies can be studied. And again, as long as we've randomly selected the two different groups, we can have at least a reasonable level of confidence that differences we observe are related to the difference in this case, in the short sale restriction policy. So just as in the overdraft study, we can study consumers who receive interest rate A and randomly selected other half of the consumers who receive interest rate B, so too the SEC can and did study how stock behaved in companies that were versus were not exempted from the short sale restrictions. The reason I'm so excited about this research direction and many similar initiatives that are underway at the CFPB as well as other places is that, of course, it's always better where possible to study behavior in the real world than to study it in a situation that may not be able to perfectly mimic the real world. And I'd like to close with a story that I always keep in mind in thinking about this point. For a number of years, I had the honor to serve on a Sloan Foundation board, a small board with a couple of other people, one of whom was John Reed, the former chair of Citicorp. And during one session, there was a fairly lengthy discussion of what was at that time really a cutting-edge study on a particular aspect of mortgage behavior. And various fine points were being debated about this study. And at a certain point, John sort of leaned forward. He said, you know, I've been saying for years that the fundamental problem or difficulty in studying mortgages is that many people come for a mortgage as a couple. And studying how two people will act in response to a policy change or a different practice by the institution can be very different from how an individual would respond. And then he sort of smiled, indicating that maybe in his own life this had been a significant thing. And I always just keep that with me, that when we're studying people in the real world, we just get the whole set of things that will be driving their behavior. And you could try to think of all these different things and, okay, do a research study where you bring in people and their spouses, but we can get that all automatically if we just can use a randomization strategy and study people going actually about their day-to-day life in the real world. Thank you.
Thank you very much. Our last speaker is John Campbell.
Thank you. Good morning. Well, I get to go last, and my colleague David Laibson got to go first. On the other hand, I'm pleased to say that contrary to Ron's introduction of me, I'm no longer chair of my department, and David is about to take over that responsibility. So I think overall I'm still the winner. So I thought I'd spend a few minutes just to talk about a lot of the research that's going on now using data from other countries, international household finance. And this is a very active area. There's a tremendous amount of research. I'm involved in some of this myself, and I'm running a grant from the Sloan Foundation to do this with various co-authors. And as part of that, we're trying to build some infrastructure to make it easier. We've created a website, household-finance.net, which lists data sets and studies that are going on in many different countries around the world. So why should one do this? I mean, if we're interested in improving consumer financial outcomes in this country, which is what we're all here to try to do, why should we look at other countries? Well, a first reason is that there's tremendously rich data available elsewhere, and there may be lessons that we can carry back just from having good data in other countries. Academics are drawn to data the way mice are drawn to cheese. Depending on the context, the Nordic countries, the Scandinavian countries, are famous for their very rich administrative data in which information on many people is linked together in a usable way. There are interesting surveys. The Eurozone is doing very detailed household consumer finance surveys. There are countries that have electronic registries of ownership of risky financial assets, so you can really look in great detail at risk-taking behavior. And then finally, the kind of randomized controlled trials that Christine was talking about and that are very common, those are also being done around the world, and we can learn from them. So that's a sort of obvious point. But a second point is that the policy and institutional environment is often surprisingly different across countries. And, actually, once you see this, you start to wonder, why is that, and are there lessons we can learn? It's not the case that consumer finance looks the same everywhere. So think about the mortgage system. If you want to know what a mortgage system looks like when it's dominated by adjustable rate mortgages, you can go to the UK. If you want to know what a system looks like when you have fixed rate mortgages but they can't be refinanced without paying a penalty, then you can go and look in Germany. Now, of course, we have to be very careful because drawing conclusions from those sorts of comparisons, because there are many other reasons that the UK and Germany are very different economies, societies, than we have here. So you can't crudely conclude from a direct comparison that you're getting the pure effect of the difference in the mortgage system. On the other hand, what's also true is that foreign countries like the US, we have changes in rules that come along and can be regarded as natural experiments. So, when policies change discontinuously and maybe affect one group of people differently from another group of people, like the example Christine was talking through, that's a natural experiment. It's very valuable. These natural experiments are both important, scientifically important, and also rare. And so we should not waste them. If they're happening overseas, we should still look at them and learn from them. Then the final point I want to make is that I think there really are consumer financial practices that we can learn to avoid and others that we might consider emulating by looking overseas. So I'll just give two examples. First of something we probably want to avoid, and then of something we might consider learning from. So in many European countries, it's common for retail investors to be marketed complex structured products for retirement savings. And these products have many option features. They often involve baskets of stocks, and there's going to be a put option feature that puts a floor, but that put option, the floor will be calculated on perhaps the basis of, the two worst performers in a group of 5 stocks. The complexity is really extraordinary. My colleague at Harvard Business School, Boris Vallée, with a co-author Célérier, has done some very interesting research documenting the growth in complexity of these products over time. And a very telling observation that they make is that the complexity is greater when the products are offered by banks that primarily serve less sophisticated consumers. Private wealth banks actually market less complicated products. And then they do some calculations of the fees, and I think we learned quite a lot from that type of research. On the other hand, let me give you an example of some things that we might try to learn more positively from. The mortgage system in Denmark is very similar to that in the US in some respects. It's dominated by long-term refinanceable fixed-rate mortgages, like the ones that we know and love in this country. On the other hand, the funding model is very different. They use covered bonds to fund the system. And importantly for today's discussion, the contractual terms are different for households. So within the Danish system, refinancing to lower your interest rate doesn't depend on your credit status or your home equity. So within that system, there's no need for the government policies to facilitate refinancing, the HARP program, for example, which we were working on over the last few years. There's no need for that because it's built into the system ex ante. On the flip side, when rates go up in the Danish system, you have the right to essentially buy back your mortgage at market value, and that avoids lock-in, which I predict will be a major concern in our mortgage system when rates rise, as inevitably they must at some point. And I'm concerned that we will see the phenomenon of homeowners locked into cheap mortgages and unable to move, and that may damage the mobility of our labor market and economy. So I've been doing some research on Danish mortgages. I'll just finish by saying that those mortgages still require homeowners to take positive action to refinance, and there's evidence within that system that people do that sluggishly. And so some people are leaving money on the table and hurting themselves by not taking advantage of a refinancing opportunity. This has been a concern in this country too. Many people have pointed it out, but in this country it's very hard to know when people fail to refinance. Is that because they forgot to do it, or is it because they can't do it, that their credit has deteriorated or their house price has fallen? In the Danish system, we can go, look, we can see people are not doing it. If they're not doing it, we know it's because they forgot to do it. And so I think we learned something then about consumer behavior. So that's just a very quick overview of some of the themes that are going on in this very rich area of international household finance. Thank you.
Thanks to all of the ARC members. For the remainder of this session, we're going to have two things will happen. I'm going to ask the ARC members to offer any thoughts they might have on what the other ARC members said. But before we do that, I would like to have our director, Rich Cordray, give his thoughts on what he has just heard.
So Chris has indulged me by allowing me to sit up here during the meeting, and it's always dangerous. So I just wanted to offer some thoughts, sort of in turn, because some of what you're talking about in terms of general research ties in very much to work we're doing at the Bureau. So first, as to David, by the way, your first comments about Boston put me in mind of Oliver Wendell Holmes Sr., the poet, who once referred to in the literary world Boston, he viewed it as the hub of the universe. It reminds you a little of the undergraduate posters you'll see sometimes on people's walls where wherever they are looms hugely on the map in the poster and the rest of the world is in very diminishing scale. So we can all reflect on where Boston fits in the field. Whether we have an optimal retirement savings system, that's a fascinating question. And, there's a lot of suggestion in what you said to indicate that maybe we have some really key elements of it in place. A basic safety net through Social Security, mechanisms for savings that are based on consumer choice, probably not taken up as much as they should be because that's how they work, but nonetheless fitting pretty well with our system here in the United States. The ability to take things out for certain purposes that are favored, but otherwise some difficulty in taking the money out, so there's a bit of a forced saving aspect once you opt in to the program. One of the things that's missing that's interesting and Treasury is working on right now is the fact that in terms of if you see the Social Security safety net as a safety net but very minimal, and really people to optimize retirement in any reasonable fashion need to do more, what are we doing for a huge amount of working people in the United States who are left out of the current 401k, IRA, ERISA type savings, retirement savings, which is all of the part-time workers, all of the temporary workers, all of the seasonal workers, all of the intermittent workers, all of the contracted workers, all of the people who are not full-time, full-salary workers. And Treasury is trying to develop a MyRA product, which would be, as you say, a retirement savings product, but also a savings product, which is very important to this too. People to be able to save, have some difficulty in pulling the money out, but ultimately able to do so if they need to meet an emergency, and how can we do that? And of course, through the state and federal systems, depending on how people handle withholding, that can be an important savings element for them. The EITC adds to that enormously for low-wage working people, but for others, depending on how they manage their withholding, they can save that way. Those are interesting questions that relate to our work as well. As to Justine's comments about data use, both in industry and government, it's been interesting for us to try to understand the way industry uses data, and of course we see that close up through our supervisory authority, being able to go in and actually look carefully at the operations of industry, and we in the government, where we're trying to compile a significant amount of data so that we can use it to detect patterns and understand how markets work. Now, it's a very different use. Industry is trying to understand data about each one of us, potentially to market products to us, and to figure out our individual behavior. We're not looking at it that way. We're looking at sort of the average consumer, consumers in the aggregate. So we're quite content to have the data be anonymized, whereas for industry that would be useless or fairly useless. And yet we are developing some tremendous data sets at the Bureau. I think was it John who said that economists are attracted to data as mice are to cheese? One of the points we're trying to get across today and tomorrow is that if that's how you see it, then the CFPB is now the state of Wisconsin, America's dairyland. We're making all kinds of cheese, and we are cheese heads, so maybe we'll have to put that into our branding somehow. But I would say that if you think about the data that we're able to compile at the Bureau and we have access to, I think that is driving considerably what we're doing. And you commented on, for industry, there's know your customer and there's also know your competitor. It's not always easy for industry to know as much about their competitors as they'd like to know. There is a fair amount of cross-fertilization because people leave one place and go to another place. Somewhat at random, sometimes intentional on the part of the corporation to land certain hires. But we're finding, for example, we have the consumer complaint database, the public complaint database, and we've always viewed that as a way for people to understand better, if they're interested in doing so, researchers and others, what this tells us about consumer complaints and consumer issues, consumer concerns. But it's also notable that the public complaint database, which has given industry a certain amount of heartburn, can also be very useful to industry, because if you're, say, Bank A, and you want to get a sense of where you stand compared to your competitors in terms of complaints and problems and the like, you don't really have much insight into what that looks like at Bank B or Bank C. But the public complaint database suddenly, instead of just looking at how you fare and how you're doing, but to be able to compare to your competitors, that's pretty useful information that people otherwise would not have had access to. So we do try to read them in on that and stress the importance of it. as to Raphael, I very much agree with your view of multiple lines of defenses to protect consumers, with the first one being, and I often speak this way, that's the first line of defense is consumer self-protection. And obviously the best line, because if you can prevent a problem, regulation is always going to be chasing problems after they've arisen at significant scale. It's important, it's necessary, but it takes a lot of time. And it's not a very nimble process. And enforcement, even more so, is institution by institution, chasing things down and then trying to fix them after the fact. You can never fix them after the fact. You can sometimes get people's money back for them, but you can't fix the impact on their lives and all the ripple effects that things have had for them. So certainly that first line of defense is quite important, and we do a lot of work at the Bureau around consumer empowerment, consumer education, consumer engagement, and figuring out how we can do that work better at scale to 320 million Americans is an immense challenge, and all the insights that you all will have on that are things we're going to be very, very interested in order to prevent consumers from costing themselves considerable amounts of money, considerable amounts of heartache, stress, changes in their lives, and the kind of regrets that we hear about now. We have a tell your story function. People come and tell us, it's not a complaint because it isn't something operative necessarily, but they'll tell us about a story in their life, and very often it's that they didn't know what they would have liked to have known at the time when they needed to know it. Now they know it, and they wish things had been different. Those are all things we'd love to put people in a position to change proactively for themselves. Christine, I thought it was very notable, we run into this all the time, the gap between what people say, sort of focus groups and survey information, and what they actually do. They often say what they think they're doing, and it's not in fact what they're doing, and you economists and academics know that best, perhaps. You're dealing with students all the time, and they'll tell you one thing and do another frequently, but they're indicative of the rest of the population. We are in a position, as you say, to have significant data sets and to be in a position to do certain pilot projects. We have our Project Catalyst, where we're required by the law to try to foster innovation in financial services. Not easy to see how a government agency is supposed to do that, other than maybe just get out of the way. But we do have a number of projects that we have now developed where they are experiments or novel or new directions, and one of the things we partner with people on in those is to be able to conduct research around them and see what they show us, which is useful both to the partner and to ourselves. And we'll have more ability to do that with institutions as we go along, so I think that's notable. Finally, as to John, other than, again, mice and cheese. The points you made about international comparisons is quite interesting to me and to us, because when we first started out as a bureau, we found that there would be certain meetings that would appear on my schedule to meet with international counterparts, because there are consumer financial protection agencies of some kind or another in most of the Western nations, and some non-Western nations as well, increasing numbers. We're part of the G20 and group working on some of these various things. But at first I saw those as just kind of diplomatic niceties, that they would come in and we would have a friendly session and present well, but it wasn't necessarily fruitful. And I found it very quickly it was incredibly fruitful, because they would be talking about the same kinds of problems we were talking about in a different context, often with different approaches. But it was often quite interesting to hear that and to think more broadly about what we were doing. And if you think back to how the theory that the states here can be laboratories of federalism with different social experiments, this was a Brandeis theory 100 years ago, and it still fits our system. The same is true of international countries who are dealing with consumers in many of the same ways we are, with many of the same objectives in mind. So that's very interesting to us, and I think we're learning more and more. And as you say, there's plenty of data there. Alternative data has to be thought about in terms of a different context, but often very enlightening as to what we're trying to do and how to go about it or not to go about it. So.
Thanks very much. I'd like to offer one broad observation, and then have the ARC members say anything else that they'd like to say on my point or others in the last few minutes. The broad observation is that a great deal of the discussion here can be described as a conversation about how do we learn, we as researchers, we as regulators, about the ways in which people's behavior differs systematically from what we might think is optimal behavior, or what in some cases is unambiguously more sort of financially sound behavior than we actually see. Raphael is interested in the extent to which people can, their financial literacy can be improved so that their financial behavior will improve. David is interested in the extent to which people are or are not behaving optimally in a retirement savings system whose structure, if it were treated optimally by consumers, might well be an optimal structure, but whether they are actually behaving optimally is an open question. John mentioned a fascinating paper from one of his colleagues about the extent to which people who are less sophisticated are systematically offered financial products that are more complex. Some of the financial products, as many people on Wall Street learned to their regret, available in today's marketplace are so complex that even the most sophisticated players are unable to anticipate how they will behave. So the key question is, how do we learn systematically about the systematic deviations between what sort of models of optimal behavior say and what people actually do? And I would offer one novel approach to that set of questions, which is to use the big wheel of cheese that the CFPB has created in the form of our complaints data and our Tell Your Story data, because that is a source of, I think, rich information about, rich and direct observation of how people think about the financial challenges that they face. In principle, it might be a very valuable wheel of cheese for people interested in for researchers interested in the ways in which people behave differently from what you might expect. So if there are any ARC members who want to comment on that or on anything else, we have a few more minutes. David?
I really enjoyed hearing everyone's comments. I'll offer up two quick comments. The first is to follow up Christine's point about the wedge between what people say they're doing and what they're actually doing. I'll tell you about one study that my collaborators and I ran a few years ago, where we had people allocate $10,000 real across 4 S&P 500 mutual funds. So this is a pretty simple task. We would all say pick the lowest fee S&P 500 index fund. These are index funds, so they all have the same assets. And what our study participants actually did is they went after the brands they knew, and they went after the funds that happened to have good historical returns because they had lucky inception dates. And they didn't in any way minimize their fee payments. However, when we asked them after the study, how did you decide how to allocate your money? The fee was their number 1 or number 2 rating out of the 10 categories that we gave them. So they were convinced they were fee minimizers when in fact they were return chasers. Second observation, following up on John's very interesting points about international comparisons, the US is actually exceptional in allowing leakage from our defined contribution voluntary savings system. If you look across other developed countries, for example, Singapore, the UK, Germany, Australia, Canada, countries that we've been able to study typically because they have English language documents, it turns out that essentially everywhere else, the 401ks or their equivalents are completely illiquid unless you face a very severe financial shock like 26 weeks of unemployment. And in many of those countries, no matter what you experience, these accounts are completely illiquid until you retire. So the US is exceptional in allowing liquidity from our retirement savings system, and hence exceptional in the level of leakage that we have. I think it's a very interesting open question of whether we've gotten it right and they've gotten it wrong, or vice versa.
I really enjoyed listening to the director's perspective and comments back on this discussion. That was really helpful and also obviously Chris's comments, understanding kind of how the relationship is between the Academic Research Council and the CFPB has been productive from both sides. And I've definitely really enjoyed engaging in discussion about research with all of the outstanding staff at the CFPB. It's actually been a real treat. It's a really special agency. So I wanted to pick up a little bit on what we can learn from other countries. I think this is a really important point. A lot of other countries are kind of, much more nimble in collecting data or further ahead in data than we are. And they also may be more further ahead in experimenting with policies in different directions that we haven't yet done. And just like I kind of read David's papers to learn about things that he's working on that I'm not, and maybe vice versa, I can kind of look at other countries and say, oh, they thought that might be interesting to try, and we could consider that in the US, but let's see how it worked, right? So two great examples are Mexico privatizing Social Security. We can learn an awful lot there, and interestingly, the way that they did it allows us to get great measures of sales force advertising of products to customers, how customers from very low income to very high income backgrounds respond to sales force and advertising, and because it's one market, what the impact of that advertising is on equilibrium fees, or fees that you end up seeing in the market. Why are fees so high in the case of privatized Social Security in Mexico? And in some of David's work, why are they so dispersed? Why are so many people paying way more than they need to? In using that amazing data in relationship with the government, we're able to learn a lot. A second interesting area, the case of Chile, which just redesigned its student loan system and has much better and richer data on college going, high school linked to college going, and tax record information to really be able to nail this question: what can we learn there that we could bring into this very important debate in the United States?
Anybody else? We're running a little late, and on the topic of international comparisons, that's our next session. Yeah, well, it has been, I think, very useful. So if there are other comments.
I was just going to add one thing.
Other comments on anything other than international comparisons?
Yeah,
because
no,
we will
I'm not doing no international for me, at least not today. I'm a little uncomfortable because I'm not a big cheese eater, and we've been on the cheese analogy. But I do think that at USC and in my center, we've been pretty effective in raising the profile of the things that we're doing using technology and media. So just listening to this, put a video out on what the data sources are, find ways to maybe have a data fact of the week or a data, ways to make the cheese as strong as possible to get as many people aware, because I do think that we're going to make more progress to the extent that we have more people working on these issues. And so things that we can do to improve that, I think, would be very important.
Just want to come back in on that point. One of our instincts at the Bureau, and we've tried hard to do this, is when we have data to be able to share it publicly. There are times we can't do that. Some data sets are proprietary. Some of our supervisory information is confidential. But we agree very much with you. There are going to be a lot of people who will do a lot of interesting things, and we want to encourage that. It's helpful to us. It's helpful to the overall goals we all share. And so to the extent that we can incentivize all of you to be looking at our information and making use of it and finding new thoughts in it that we aren't having at the moment, that's pretty helpful. I want to go back, David, just specifically on your topic again, because I do think this is quite important, and I got a sense that you were not necessarily buying into the particular point of view that concerns me in this area of retirement savings systems. When you describe money out as leakage, which is, you know, a quite useful, helpful term, but it also potentially has a normative aspect to it, right? That inevitably leakage would mean negative. That is, you're trying to lead people to save for retirement, and if money's leaking out, they're not accomplishing that objective. At the same time, and I got a sense this was your outlook, but I think it's important for people to think about these things, to think of it this way. We're trying to incentivize people to save, ultimately for retirement, but also for other needs they may have. And as you say, the United States system is interesting because it will allow certain money to leak out for certain purposes, which may be more valuable to people at that time and may lead to a better retirement in other ways. For example, taking out for education is an obvious method, right? But when we talk to Treasury and we're working with them in the MyRA program that I was describing, that I think is quite important here to supplement and fill out further when you think about the retirement you're talking about. It's a subset of the population and maybe a much smaller subset than we tend to think. They tend to think of it as a MyRA project to get to retirement, but it also could be a savings method for people that is better than just a savings account, because there's still a fair amount of impulsiveness that can get into behavior toward a savings account. But here, there's just a greater threshold to get over. You can get your money out, you can make a choice, but it's more of a deliberate choice. But that's pretty useful for people to be able to do that. So that is something we're thinking about, but I wouldn't want people to get caught up in nomenclature and necessarily think there can be positive leakage, and that's important to understand as well, it feels like to me. And my sense is you're of that view too.
Yeah, precisely. Let's ban the word leakage. So actually, our analysis suggests that it is, on net, a good thing. And so for all of the negative consequences of money coming out of these accounts for the wrong reasons, maybe self-control problems, other issues, the positive outweighs the negative. And so we conclude, just as you do, that it's a net plus.
But we'll need to continue to work on and influence policymakers who tend to see these programs as set up for retirement, and therefore anything that somehow gets in the way of that is necessarily bad, when that's just a part of the objective and not the whole objective of financial well-being for people, right? Yeah.
Can I add one thing back to international evidence? When you look at investment behavior in Mexico and how people are choosing their fund manager, there are two things. One of the main things that makes them value that retirement account is their ability to draw it down for unemployment insurance. It's actually linked. And so having something that's an immediate benefit and not so far off in the future that this is something that could benefit extreme needs today really adds a sense of value for people when you ask them in a survey or when you look at their behavior to that account. The second thing it does, and this kind of gets back to thinking about what works, and I know a lot of David's work has found this as well, is that people tend to pay attention to something when they have to sit down and focus on it for a reason. So if you look at when are people most likely to switch fund managers in Mexico, it's when they have to file the paperwork to withdraw the unemployment insurance. That's a point in time when somebody's looking at it and saying, why don't I have more money in this account? And maybe I should be thinking about the fees that I'm paying and my asset allocation. And it's a great time at that point, for example, a partnership between, well, if we were in Mexico, it would be CONSAR and, EAMS, the unemployment insurance benefit, but a cross-government partnership to reach people at that point in time with information they might need, because now they're paying attention. And it's exactly this immediate benefit aspect of the account that gives you this ability to reach them and makes it immediately important and at the top of their mind for doing a better job with managing their savings for retirement.
We've been learning about that as we go, and we talk a lot in terms of meeting consumers where they are, just-in-time information that they can access when they need it. They don't care about anything about the law or rights involving debt collectors until suddenly a debt collector's calling on the phone 14 times a day, and then they may want to know all about it suddenly. But for example, it is a common phenomenon that many people don't really focus on their retirement until they're getting very close to it, and then they tend to know all about it, but they probably should have known all about it 20, 30 years before. The other notable period for many, many people, and a lot of efforts, including ours, are focused on it, is with the EITC, the tax time moment. That is one time of the year that there's a very significant change in people's financial position. Creates a lot of risk for them because they can do well with it or do poorly with it, and you know, it's not for me to say they did well or poorly, but just that they're thinking hard about what the right choices to make, because suddenly they have optionality, and they won't have it most of the rest of the year, where they won't get a lump sum of that sort. And also it's a time to be protecting them, because there's many others who know that lump sum is coming to them and would love to get hold of as much of it as they can. So these are interesting things for us as we're working on consumer empowerment, consumer engagement, but I would very much agree with you that it has to be contoured to consumer behavior, consumer understanding, and there is a very immediate focus people have on immediate events, and then a very vague connection and a lot of disengagement most of the rest of the time. So.
All right, I think with that, maybe we should go to the slightly delayed break, and let's say we'll start again at 10:25.